What is up, everybody? Logan here again, coming at you guys with a new video. And today we're going to go over Hedging Lab. And this is a video that they've wanted me to make for a little bit. And I have a little creator code with them as well to help you guys get a discount if you're interested in this. And I find it to be actually pretty helpful as of lately. They gave me an account to use. And I've just been going through it, testing a couple things, and might test some of these strategies and some of the earnings we have this month, just because it's really cool to look at back tested data and then take a look at what they expect the move to be, right? I do a lot of trading off the expected move. There's a lot more volatility in these stocks, and I just trade the S&P, but I'm really excited to see what I can do with this. But first, let's get into what Hedging Lab has created for us. They said there are already many indicators available, such as implied volatility and average true range. However, none of the current volatility indicators can be used to compare with actual price movement. We've been working on an indicator that can tell the market expectations of the stock price for the next 5 trading days. This will allow us to utilize weekly options to create a trading system, right? Include the earnings date, and the calculation does not work as we would like. One major reason is that the earnings dates can be changed. Any formula includes earnings dates cannot be back tested. We need a solid indicator that always produces the same value by the given date. So to get around this limitation, they developed their own indicator called the Hedging Lab Volatility Index. Here's how that's calculated. Calculate the end of each trading day. Step 1, select the next 3 option expiry dates. Step 2, for each of the expiration dates, use the money at strike to calculate straddle cost. Step 3, draw 3 values with the number of days until expiry is the index. For example, if today is Tuesday and 3 straddles costs are 5%, 10%, 15%, we will note 3 days 5%, 8 days 10%, 13 days 15%. Use linear algebra to calculate options values for 5 days. In the example, the final value is roughly at 6.5%. This indicator rises before earnings and falls after earnings because of expected volatility. When actual stock price moved over this index, we can expect a profit from the at-the-money straddle. By calculating average value just before each earnings date, we can roughly estimate the market expectation for a certain stock. Example of use: by comparing historical expected volatility and current expected volatility, you can find undervalued options and overvalued options, which is pretty much what I would utilize this for. And if we take a look actually at the screener, right? These are all in alphabetical order as of right now. You can take a look. Here's Apple. See the short interest, the dollar volume, right? We have the earnings date they have tracked for us, which you guys can also find over in the earnings prediction. This is where they predict these companies to announce their earnings, right? And I like to just use the calendar, honestly, anyway. Take a look at the month. Sometimes I use the week too if I'm taking a look at everything, but I do want to test it on some of these bank stocks, especially with how volatile they have been as of lately, and maybe even Delta, right? Delta Airlines. Here's the historical options trade report, and this is a really cool little function as well. So we're talking about Delta, right? Delta Airlines, DAL. So you can take a look and say, okay, let's go back to 2020. Let's say we wanted to know from April 1st, April Fool's Day from 2020, in our option strategy that we were going to try on Delta Airlines was naked put, right? And minimum 1 trades. What's our earnings entry rule, right? So our earnings entry rule would be we're going to enter 2 days before. Our exit rule is 1 day after. And if we were to enter an at-the-money strike, right, strike price on Delta and generate this report, you would see that this is actually not a profitable strategy over these past few years. You can see that here, right? You would only win 25% of the time, but your return percentage would be minus 227%. So every time you bought a naked put at the money, and it's mainly because Delta probably just didn't exceed the expected move, because as we know, when there's high volatility and it comes to an earnings report, you have to greatly exceed what's expected to become profitable if you're doing naked calls and naked puts, right? Here's another one. I like Zoom, right? Zoom is a great stock over the last 3 years until about this last year. So if we actually did this from May of 2017 till about now, you entered 3 days before, exited 1 day after. Let's generate this report. You actually would only win 25 or 20% of the time, right? But your return percentage is 125%, because there are a lot of times in this last 6 years where if you just bought a naked call, Zoom would actually exceed the expected move. And there are a couple outliers, right? And you can also download the details to your computer as well if you would like to. That's one example, right? So you can say, okay, Zoom for the last 6 years, has been profitable if I just buy naked calls. You only win 20% of the time, but you're actually up 125% just because that had been such a solid bullish stock. And then even right before then as well, it was a pretty decent stock for a lot of people to own when it came to around their earnings reports. So that's one way you guys can utilize this, which I think is awesome. So if we take a look, that is under this tab right here, right? Historical options trades. Now, if we hop back over to the volatility index scanner and we click on a stock like Apple, right? Now it'll take us to this. This is one of my favorite charts. This takes me to show you where the next earnings are May 4th, right, 2023. In the volatility rank, if we take a look at all the stocks, Apple is really relatively low. And that's something you and I know. Apple's such a big stock. We can come down to the 7-day volatility index, and you can see what Hedging Lab was pricing in, right, for their volatility and what the actual move was. And it always seems to revert right around earnings, right, where Hedging Lab was pricing in 7% and they were 5.77%. But then after the earnings, right, they dropped to 3.82% because the volatility got crushed. And you could see the actual move of Apple right up here, the 10.19%. And you can take a look at some of the other stocks, right? Here's a nice bar graph on the actual movement versus what Hedging Labs had priced in. And honestly, they had a lot of very accurate, right? Except over here, the most recent one wasn't, but that's just how it goes when you have data, right? But overall, these last few had been pretty accurate to the move. You guys can see, as we were talking about earlier, this is what would be profitable or not based on how you traded these. So if you look at the last few reports, if you were to do a call, right, and you entered right before earnings, exited right after, here are your stock price. This is what it would cost. This is what would have happened to your trade if you did that. Here's if you did it in 2022 in October. If you just bought a naked call, you would have exceeded it and you would have made a pretty decent amount of money. It would have cost $400 roughly to get in. You would have made $679. And this will show you, right, how successful these strategies are. And if you look at this report, each of the trading results based on these following rules: entered before earnings, you chose an at the money strike, and you exited after earnings. And you can see that your best bet over here, naked call was 50-50, your condor shot was 50-50, and this double diagonal lost more than it won. So did the straddle. And then you can take a look here. Let's say it added 12, right, the most recent earnings, and you can still see here that Apple's probably not a great stock for you to do this on, depending on what your return is, right? Because you can, as a trader, you can lose more trades than you win and still be profitable. And that just comes from what your expected ROI is as well. And that's one thing that a lot of people should keep in mind, is even if you have a solid strategy, if it loses a lot, you can still make profit, really good profit. But if you have a strategy where you're winning a lot, but your losers completely wipe you out, that's always a really tough spot to be in, because it's hard to have a profitable strategy when statistically the odds are working against you, right? So if we take a look back at the historical option trade spot, this is one of my favorite ways to use Hedging Lab as well. Remember how we typed in a symbolist earlier for DAL, and we were looking at a lot of the airlines, a lot of other stocks. If we did something like, let's say you want to look at the last couple of years of how a strangle worked, if you entered it 3 days before earnings and then exited 1 day after without any sort of symbol list, you're just looking for the best results. If you hit generate report and you do the top results, get top results of the last 30, it actually shows you all of these stocks. PayPal, here's one here. That's a very popular trade. If you take a look, it shows you the winning percentage of the strangle. If you were to take it 3 days before earnings, you exited 1 day after, and your strike delta was at the money. And it shows you your return percentage too. So if you took those 12 trades on PayPal over that 3 years, you'd be up 374% on that specific strategy. And it only won 66.67% of the time. So if now, you want to create a watch list off of these, you could go down to create watch list, right? And you can take a look. Here's a day trading one, a swing trading one, and here's your history report strangle. These are two I made earlier. But essentially this gives you those 30 symbols we were looking at. Here's PayPal, right? And then it'll also tell you the next earnings date they have, so that you can test these out yourself and say okay, You know, AT&T's been great for it. PayPal, Qualcomm's been great for it. Lyft, and DraftKings, for example. There's another one, Dollar Tree. And you can take a look and set these strangles up and see if you're hitting at around that same rate that they previously mentioned, right? And that could be one of your edges as a trader, is just being able to do that and just trading specific strategies around specific events, right? So we'll go back to what we were looking at earlier, which is Delta Airlines over here. And we can take a look at their volatility rank and their low to medium, which is probably a pretty solid spot to be in. 7-day hedging volatility is 5.61%. Their 30-day implied volatility is 40.196%. You guys can see that's a 1.7% change from 2 days ago. You can take a look at some of the other stocks, but here's also, if we take a look, the last time they announced earnings on January 13th, right here, look at that 7-day movement, and their 7-day hedging lab volatility index showed the exact same, right? Now they're a little off back here, right, from the actual movement and over here. But with the most recent report, you could also use that to say, okay, if I think it's going to stay true to what Hedging Lab's providing me, I'm going to trade XYZ strategy. And you can come down and look here, and maybe I'll test something out, maybe do a little paper trade with some of this information down here and see, hey, how can I best utilize Delta Airlines and try to make some money on earnings? Maybe I do a put credit spread, try to get that volatility crush. I find that to be really helpful. One thing I did want to touch on really quickly, if we come down to, if you guys do want to subscribe to Hedging Lab and get this data, if you actually use promo code Logan Ladge in all caps down here, you get a monthly discount for the first 3 months down to $15. And then on the annual plan, you actually save $60. So that's a little bonus if you use code Logan Ladge. So don't forget to do that. You can also reach out to their support under the support tab. That's very helpful. They have a lot of API stuff they've been working on as well. They have the earnings date prediction over here as well I wanted to touch on, which is earnings data is only confirmed a few weeks before the actual earnings date. Being able to estimate when earnings data will come out can put a trader well ahead of the curve. Being able to estimate earnings data allows a tool or trade screener to be more effective as an expiry date can be chosen. Currently, this is a major challenge for any trade scanner or tool. However, is a challenge that can be overcome with AI and machine learning. Taking a look at Apple's earnings dates in the past, which is something we did. The data can be fed into our proprietary algorithm developed by our AI team to make an accurate guess for the next earnings date. And they predict that to be April 28th, 2020, from just all of this data back here, right? And not saying like for as of right now, that's just when it was taking a look at the last 11 years prior to that. You guys can read the rest of this if you would like to. I'll read the last sentence. With that said, we are confident in our info and provide it because an asset to any trading strat. We are traders ourselves, and the information provided to clients is the same information we use to act on our own trades. So I'm going to be diving into this a little bit more. If you guys really like this, make sure you guys go check out Hedging Lab. The link is down in the description below. I really appreciate all the support. Like I said, I'm going to take a look at some of the bank earnings with how volatile they've been, see if I can get any sort of edge, whether I'm doing a condor or just taking a deeper dive and looking at this data. But I really do appreciate you guys getting this far. Make sure to leave a like, a comment, and subscribe if you haven't already. That's going to be everything for me in this video, and I'll see you guys in the next one.